Welcome to the deep dive. We're looking at a listener scenario today, really getting into the details of a specific financial move.
That's right. We're talking about someone, let's call him Matt, 58, married, who was looking at his life insurance.
A big policy, actually.
Yeah, a $7.77 million variable universal life policy, a VUL. And it had, what, about $2.1 million in cash value built up?
Exactly. And, with a VUL, that cash value is tied to market performance. Potential for growth, definitely.
But also potential for, well, volatility, which
Mm.
seems to be what Matt was starting to think about.
Right. As he got closer to retirement, that market risk probably felt a bit different. So our mission, let's say, is to unpack the strategy he used to shift towards more guaranteed protection.
Okay. And the core mechanism here was something called a 1035 exchange. Can you break that down for us in simple terms?
Sure. Think of it like this. A 1035 exchange lets you move funds from one life insurance policy directly into another one without having to pay taxes right away on any gains inside the original policy. Ah, okay. So it's a way to kind of reposition your insurance assets without an immediate tax hit.
Precisely. It's designed for that switching policies when your needs change.
So Matt used this 1035 exchange. He took that $2.1 million cash value from the VUL and moved it into a different type of policy, a Pacific Life Promise Guaranteed Universal Life, a GUL.
Yes. And the key word there is guaranteed. That was the goal.
So what did this GUL give him that the VUL didn't? What was the trade-off?
Well, the big thing was the death benefit. With this new GUL, that $7.77 million death benefit is contractually guaranteed, locked in, all the way to age 95.
Age 95. Wow. So completely removed from market ups and downs affecting that payout amount.
Exactly. Big peace of mind factor there compared to the VUL where, performance could impact things.
And I read that after moving that $2.1 million over, he didn't need to pay any more annual premiums to keep that $7.77 million benefit.
That's correct. The substantial cash value he transferred was enough to essentially prepay the policy, ensuring the death benefit stays in force until age 95 without further out-of-pocket costs.
Oh, okay. That's pretty significant. No ongoing premiums simplifies things quite a bit.
It really does. Now, there's also another feature, something called a lifetime no-lapse guarantee rider.
Right, the no-lapse guarantee. What does that rider add? Sounds like more security.
It is. It's like an extra layer. Basically, as long as you meet some minimum conditions, you can't just let the policy completely drain. For instance, this rider makes sure the policy won't lapse, won't terminate, even if, say, the internal costs were higher than expected down the road. It reinforces that death benefit promise.
Got it. So it protects against the policy potentially running out of steam unexpectedly.
Yeah, exactly. And Matt even had an option, for an extra cost, mind you, to extend that no-lapse guarantee all the way to age 121.
So really long-term security, if he wanted it. It definitely sounds like he made a conscious choice.
Yeah.
That giving up the potential for higher cash value growth in the VUL for the absolute certainty of the GUL's death benefit.
That's the trade-off in a nutshell, moving from market potential to guaranteed stability for his beneficiaries.
Were there any other sort of benefits that came with this particular GUL policy?
Yes, there was one more significant feature often available with these types of policies, an optional chronic illness rider.
Chronic illness rider. Okay, how does that work?
Well, it provides what some people call living protection. If Matt were to be diagnosed with a qualifying chronic illness, as defined by the policy rider, he could potentially accelerate, meaning access a portion of that death benefit while he's still alive.
Ah, so he could use some of the funds intended for his beneficiaries to help cover costs associated with a serious long-term illness if needed.
Exactly. It adds a layer of flexibility for unforeseen health challenges later in life.
Okay, let's recap then. Matt, concerned about market risk in his VUL, used a 1035 exchange
Right.
to move his $2.1 million cash value into a GUL. This secured his $7.77 million death benefit until age 95, eliminated the need for future premiums.
For that base guarantee.
Added protection with a no-lapse guarantee, and even gave him potential access to funds during his lifetime if he faced a chronic illness.
That really covers it. It's a clear example of how a 1035 exchange can be a powerful strategic tool, especially for, high net worth individuals looking to de-risk their insurance as financial priorities shift.
It certainly makes you think, how our own situations change, how our comfort level with risk might evolve over time.
Absolutely.
It prompts a question, maybe, for our listeners. How might changes in your own life make you reconsider the tools you already have, like life insurance? And what are the real long-term implications for your plans, your legacy, when choosing between something guaranteed versus something tied to market growth.
That's a great point to ponder. It's all about aligning your financial tools with your current goals and risk tolerance.